Hi, everyone. Get ready for the How I Raised It podcast, the show where you get an inside, unfiltered look at how real entrepreneurs raise capital for their businesses. I'm your host, Nathan Beckert, and thank you for tuning in to today's episode with Brett Fox. Brett is a startup advisor who has worked with dozens of companies, and he shares a ton of really valuable advice for startup CEOs. If you're tuning into this podcast to learn how to raise capital for your startup, I've created a super valuable free welcome package for you. It includes a list of 2,500 investors who don't require a warm intro, plus 200 of the most important questions that investors are going to ask you. So this package is really going to help you get prepared so you can go raise capital. To get instant access, please click the link in the first comment. And while you're there, please leave us a nice comment. Tell us what you like about this show. Last but not least, if you enjoy this conversation and think someone else would too, please share it with them and hit that subscribe button to get all the latest episodes. Thank you so much. Sit back and enjoy the chat with Brett.
Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by foundersuite.com. Today I have Brett Fox, hailing from Cape Cod, normally in California. Brett is a startup advisor. And with that, why don't you do a quick intro on yourself, Brett?
Yeah, no problem. So right now I'm on a college trip for my daughter, looking at all sorts of colleges, which has obviously nothing to do with startups. But anyways, it's been a fun trip. We're on our way actually tomorrow to Europe to look at colleges over in Europe. So it's a long extended trip looking at all sorts of different schools all over the place. My own background is I've been a CEO. I've got kind of this interesting background where I've been involved in very large companies. I've been involved in startups as both an entrepreneur in residence. So I've got kind of a view of how venture capital works. And I've been a CEO, and now I'm advising startups. So I've kind of seen all the different angles involved in building companies.
Yeah, cool. What college is in Cape Cod? I don't know my East Coast geography.
None. This is a quick little vacation. This is like a 3-day vacation before heading off. So we were looking at all the colleges in and around Boston, that area. And we went and saw Brown on our way down here, which is, I think, my daughter's top college right now that she's interested in. And then drove to Cape Cod, and then we're going to drive back to Boston tomorrow, and then off to Dublin.
That's
and then
fun.
off to UK after that.
Cool. That's exciting. That's
yeah.
When I was in college, in high school, my dad and I rented I want to say it was a Mustang convertible, and drove from.
Oh, how fun!
I lived in Colorado. Grew up in Colorado. We rented one in San Diego, and literally drove up the coast, just stopping at all the colleges: Pomona, Claremont, McKenna.
Okay.
Whatever the one in Malibu is called.
Pepperdine.
Pepperdine, that's the one. Pepperdine, and up the Highway 1, and then Santa Clara, where I ended up going, and then all the way up to like Oregon and even Washington, and looked at Puget Sound and small colleges. Such a fun road trip. Good having a great experience like that with your daughter. So.
Yeah, those are great memories to have, and great to pass on to your kids if you can. Definitely.
Yeah. Cool. Excellent. So, where do we start here? How many startups are you working with right now, and are any of them fundraising? What's kind of your...
Yeah, so I'm working with about 15 startups right now, everything from bootstrap startups to companies that have raised $150 million, so the whole gamut. I have 2 companies which just raised about $20 million in funding. I've got a few more companies that are just going to go start out and raise money in the next few weeks. So I've kind of seen a lot in the last year. And it's been interesting, because I would have thought a year ago with COVID that it would really hamper the ability of companies to raise money, but it has not been that. If anything, it seems like things are accelerating. I don't know what you're seeing, but that's what I'm seeing right now.
Seeing the same. It's absolutely crazy. We've never been busier. Our platform, Founder Suite's never been busier. There's never been more startups like actively raising and seeming to find some pretty good success raising. It's kind of crazy.
That's fantastic.
I'm telling founders, we just did a newsletter last week, and like one of our little taglines was, I think it was saying, according to Crunchbase, like first half of 2021, it's like a record-setting amount of venture capital. And our little follow-on line is, it's just never been a better time. There has never been a better time to raise capital, which is kind of crazy. Like you're saying, that we're just getting out of a pandemic, or, whatever. So it's exciting. Now, one thing I'm seeing a little bit is the shift back to a little more in-person meetings and live meetings. Are you seeing your founders taking meetings now, or is everything still happening on Zoom?
Still, with the people I'm working with right now, still over Zoom at this point in time. Maybe it'll start changing, but at least this group of people, I'm not seeing it yet.
Yeah, and now as we're recording this in late July, we're having Delta variants popping, so that could all.
Yeah, exactly. It may change yet again tomorrow and revert back.
That's all interesting. One of the things we're going to talk about is kind of the team component of fundraising. Maybe one question I'll start off with is,
sure,
from your experience at the seed round, what are the expectations of what the management team should look like? And at the Series A and Series B rounds, what do the management teams need to look like? How complete, which roles need to be filled, so on and so forth.
Okay, so I think if we're talking seed, it can just probably be you as the founding CEO and maybe one other senior person. Typically, if you're the technologist, then maybe somebody on the marketing end. If you're not the technologist, then a CTO. And that probably suffices at that stage. Then as we start getting to Series A, we've got to start building out our team. And we've got to start having more of a team around us. Then if we're going obviously beyond that to Series B, Series C, then suddenly it's going to be the team, it's going to be the team below the team, and all these different levels of organization that you're going to start having to have to keep growing. And, there's the old saying about what is the job of a startup CEO, and it's really recruit, 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 sell, sell, sell. And that turns out to be true regardless of the stage of company for pretty much the life of the company, that's what you end up doing.
So pour some more granularity around this, and maybe there's a lot of blog posts, articles out there about what level of traction, monthly revenue you need for like a Series A and so forth, but what is sort of the template for what the team needs to look like? I mean, like, give us a little checklist.
Okay, so from a team perspective, if I'm going to be raising in today's world Series A funding, I'm going to want to have a reasonably complete team around me to go do that. I'm going to want to have myself as a CEO. I'm going to want to have either a VP engineering or a CTO. I'm going to want to have a VP marketing. Probably my revenue is beyond $1 million ARR, so I might be at this point having a VP sales. I'll certainly have a sales team of some sort around me. And I'll probably be transitioning to having a really senior person, hopefully take the company and start scaling it from a revenue standpoint. If I'm on the manufacturing side, then I might have a VP of operations, as well to start adding to things. So the management team is going to start rounding out and becoming more complete. And then depending upon the company and depending upon the people that you're working with, somewhere probably between $1 million and $10 million, you might start thinking about having a CFO. At somewhere in there. A good controller at $1 million ARR is probably fine. As we start inching towards $10 million ARR, then suddenly, a CFO is going to become more important. So I would say that's probably a good template for you to follow.
Yeah. Does every Series B need a CFO? I mean, is it kind of a given by the Series B? You've got to.
I think so. I think probably. I mean, there's always an exception to everything, but I think in most cases, you're probably going to need somebody, like that, and it's going to be probably asked of you. If you don't have it, what's your plan, and how are you going to do it?
And at Series A, you kind of mentioned like maybe a VP of sales. I guess the Series A, how much of sales, or even not necessarily direct sales, but how much of the sales leadership is CEO versus someone else? I guess where do you start to sort of transition it? I know it's a hard question because
it's a great question, because I think it's something that people get tripped up on, especially early on. I've seen this a few times, especially if you have a technology background and you've never sold before and you think, oh, I got to hire a salesperson. You're going to be the best salesperson for your company for the life of your company. Period. End of story. Now, as time goes on, you're going to learn to leverage more people. And usually if you look at the steps, the first step is going to be, you're going to be doing pretty much everything, depending upon the model, depending upon the company, depending upon what you're doing. But in most cases, you're going to be doing pretty much everything. Certainly, you're going to be closing every deal, I would imagine, unless you're, selling something that's very low priced, therefore a totally different model. But still, you're going to have to be heavily involved in the sales process. As the company scales, you're still going to be closing every deal. Now, you may have a couple salespeople generating leads for you. And those people, once you teach them what you've done, they can replicate it. Then the next step after that is going to be, okay, we have a model which is scaling, but we want to go faster. And we're at a size now where we can get somebody who's world-class to help us go from our $2 or $3 million ARR to the next 10x number, to 20 million, $30 million ARR. And now we're going to go hire that world-class sales VP to help us do what we need to do, because now the job is big enough and meaty enough for us and exciting enough for a world-class VP of sales to jump in and help take us to that next level.
Yeah. That's good. I even though I think it's sometimes hard to force these answers.
Yeah.
I think having definite things to sort of aim for, just guideposts, right? Guideposts for founders is really, really helpful. So that's why I'm pinning down a few of these things.
No, that's great.
Interesting. What else, as this show is about raising capital, any other thoughts on like how to build and groom your team prior to fundraising, or the optics of your team that trip people up?
Yes. Okay, so I've got some real definite thoughts on this. This is not about your ego. This is not about your team's ego. This is about raising money. So think carefully about who you're going to bring to any meeting you have with any investor.
Sure.
So let's say you have a team of 5 people. Should you bring all 5 of your executives to a meeting with an investor? Probably not. My guess is maybe 1 or 2 more people. It should only be people, the general rule, who are going to add value in the meeting. Because of all the slides in a pitch deck that'll trip people up, that seems like the most innocuous, that seems like the most simple to present to people, it's the team slide. And the reason is because imagine, here we are, we've gone through our executive summary, we've gotten people excited about our business, and we've got this, I've seen this happen. We have a team of like 8 people in a room, and it takes us 20 minutes or 25 minutes to go through the team as every single person introduces themselves and spends 3 or 4 or 5 minutes, and it's just insane. And then suddenly the iPhones come out and the partners are just lost interest, and it's done. So the general rule is bring yourself and maybe 1 or 2 people who you think are going to augment what you're going to say, and then rehearse. Really rehearse your bios. Your bio should take no more than 2 minutes as CEO. And then any executive you bring should maybe be 1 minute. So that means you can get through, if you've got 2 other people with you, in 4 minutes, and then maybe 1 more minute to talk about the rest of the team. And now you haven't lost momentum. You've done it crisply. You look like a cohesive unit, and you've moved on to the rest of your pitch. Much better way to go than not doing it. And this is also a leadership test for you as well as a CEO, because part of your leadership as CEO is saying no and giving people tough medicine and saying, look, I know you wanted to go. I know it's a cool thing to go pitch to VCs, blah, blah, but you know what? It's not important for this one. Let me explain why. And then you have to walk them through it gently. And there may be some hurt feelings, but you know what? The goal is to raise the money. It is not about people's ego. And you have to really think about this when you're raising money.
Totally. One of the things that I used to consult to startups, and one of the ways I could actually make money as a startup consultant is I would be the numbers guy, because that's a weak spot for a lot of founders, and they're often insecure about the numbers. How is that a red flag to an investor if the CEO is maybe passing off numbers related questions to the
Yeah.
CFO. What do you think?
Oh God, 100%. I think you got to know your numbers. And there's a certain set of numbers you should always know, right? You should always know your revenue. You should always know what your break even point is. You should always know the date you're going to break even. If you don't know those things in terms of your revenue, your break even point, how much cash is going to take to get to break even, all of those various things, then you're not in control of your business. And that shows, and especially early on, when you need to be really hands-on, those are massive concerns in my humble opinion.
Yet a few minutes ago, you said the main job is recruit, sell,
Yep.
sell, sell. So
Yes.
it's hard to be both a numbers guy and a salesperson, right? Those are almost two different types of brains. So
Yeah.
how do you
Well,
reconcile that?
that's just part of the job, right? You've got to wear a lot of different hats when you're running a company, especially early on. Eventually, you can add more people, but you should always, 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 even if you have a good controller, even if you have a good CFO, you should know your numbers. I mean, it's not that hard. You just have to do the work, and you just have to pay attention to what's going on. So it's just part of what you have to do when you're running a company.
Well, I don't know if this was good or bad, but I used to
Mhm.
make a cheat sheet for the founders, the CEOs who would be the
Mhm.
ones, and I would often go with them to the meetings as the kind of fractional CFO, but I would give them a little cheat sheet, even
Mhm.
on sometimes note cards,
Okay.
right? Very
Yeah.
old school, and have them kind of study those. However,
Sure.
which was fine, but if the questions from the VCs delved into more granular stuff that wasn't
Mhm.
those top 10 metrics, it got
Right.
a little tricky, right? So,
Right.
yeah.
Absolutely. That makes sense.
Which was tough because they didn't want them to look embarrassed. They didn't want to, but you can't know I mean, yeah, there's a lot of data that you could pull out of a business and
Mhm.
not all of them is relevant.
Mhm.
What if a key person leaves in the middle of fundraising, or co-founder leaves, or how do you message that, or does that kill your deal right away?
Well, I don't think it kills the deal, interesting enough. Now, I've been through this. I've worked with a lot of people who've been through this, and the advice you're going to get is going to vary. When I went through it, my investors told me, "Oh, you can't tell, potential investors what's going on. We have to keep this guy." And it was the worst advice humanly possible, because
Mm,
imagine the box you've now put yourself in as the CEO. Because number one, what are you trying to build when you're raising money? You're trying to build a relationship with somebody, and it's based on trust. So what happens now if I'm misleading somebody on the other end of this? Well, I've lost my trust. Now what's going to happen when the eventuality happens and they're going to find out, that this executive, whomever it is going to leave, or is leaving, or is left, or whatever? Well, you've lost your credibility. And once you lose your credibility, that's when you lose the deal. What was
mhm.
interesting in my particular case was that the person who we had a problem with, I have to laugh at this. When diligence was done on him, the diligence came back so bad that when I told my potential investors that he was leaving, they were like, "Oh, okay, that's good. Our diligence told us he was a real issue." So it's like the greatest thing in the world. So the answer to the question is be honest. Do what's called get ahead of the story. That's the smartest thing you can do in the world, be it this, be it whenever you have to deliver bad news to investors, is get ahead of the story. You control the information. You're not lying, but you have the ability now to explain to people what's going on and why, and what your plan is.
Yep.
If they find out before you find out, or before you tell them, then you're gonna be on the defensive, and it's going to appear defensive. It's going to appear like you're hiding things, and that's when you lose your investors. The other way around is so much better. I recognize it's scary, but you know what? They're going to find out anyways. And if you want to be the CEO of this company for a while, then this is what you do, because you've built integrity, you've built trust, and if they're out, they're out. That's the reality, and then you're going to go have to deal with this anyways.
Yeah, for sure. When you told that story of the guy who was leaving,
Yeah.
and that actually gave me a thought. Would you ever recommend that a startup team prior to fundraising hires maybe an external diligence firm to literally like run
Oh,
diligence on all the team members and see if anyone comes up as a bad apple. I've
you know,
never heard
that's
that being done, but it's,
I've never either. It's such an interesting thing. I think you could probably ask if you've already raised some money. I guess it depends upon where you are in the process. I'm thinking about myself because I went out and raised Series A first. You'd probably ask your investors, and they would probably give you feedback. Yeah, I've had all sorts of crazy things happen. I don't know. I mean, if you believe in your team,
yeah.
there's always bad news about anybody, on your team, and hopefully you know your team reasonably well. I mean, my mistake, it was kind of a double mistake. The person was recommended to me by two people on my board. I went out, I didn't feel great about him, and I ignored my instincts, which is like a cardinal sin, right? I didn't trust
Mhm.
myself. I'm saying, oh, the board really loves him. He's going to fill a key role. Okay, I'm okay with him. And I should have been smarter. I still bang myself over the head over it because it caused me a lot of angst and problems I didn't need. And all I had to do, and this is, by the way, for anybody out there, it's your company. You're making the decisions, not the investors over who you hire. That's your role as a CEO. And you're going to get recommended to you all sorts of different people. And you're under no obligation to hire them. And your investors will be fine if you pass. They'll be okay with it. That's the lesson. That's one of the key lessons, at least for me in this. And it's kind of funny. One of my other advisors had the same thing happen to him years ago as well. He was a CEO, and he was telling me, "Yeah, I did that and almost killed my company." In doing that, somebody one of my investors gave me this great advice, and I followed it, and then it almost destroyed me in the process.
Mm.
It's fairly common. So the key is trust yourself. You're in charge,
Mhm.
not your investors, of your personnel decisions.
That's good. Good. Excellent. What advice do you have? One of the questions I get from time to time is sort of this fear of losing control as the founder, right?
Yeah.
The scenario where you've poured your life savings into this, you've worked without a paycheck for 3 years, you've now raised a seed round, now a Series A round, and maybe it's a Series A, maybe it's a little bit later, but you
Yep.
now have lost control of board and maybe majority ownership. Like, and
Mhm.
what's the worst case scenario? You get fired. I don't know. How do you counsel people through that sort of?
Yeah. Okay. Another great question. So, what's the key? The reality is the second you take outside funding, and if you're losing money, then even if you own 70% of the company, you've lost control in that way of thinking about it. So,
Mm-hmm.
what's the answer? The answer is execute. Focus
Mm-hmm.
on executing your plan. Recognize this. In today's world, investors do not want to fire you. It's a key point because the reality is there's so much information you have, there's so much inherent knowledge you have of your business that if you go, there's a high likelihood that the company is going to fail. This happened to a company my wife was involved in years ago where the CEO was doing great work. And then for whatever reason, the board fired him. And it turned out there was a little palace coup that happened with the VP of engineering.
Mm.
Company failed completely. Then the same CEO started the exact same business again and succeeded. So I think VCs have gotten a lot smarter about this, and they're not so apt to want to fire you. So recognize that, understand that if you execute, everything else works. Nobody's going to want to fire you if you execute. If you don't execute, it doesn't matter what your ownership is. In all likelihood, you're going to lose at some point in the game. So focus on the things that matter.
A related question that just came to me,
Yeah,
as you're putting together your pitch, you've got a financial forecast in there showing
yeah,
this hockey stick growth.
yeah.
Well, how often do startups actually hit this hockey stick growth? I don't know, but I'd assume less than 50%.
Oh,
So I
yeah.
guess, how do you balance that, right? Forecasting a beautiful dream and vision, yet the reality is your odds of actually hitting that are maybe, low. I don't know.
Mhm.
So do you
Yeah, I think.
sandbag your growth prospects, sandbag a little bit so you're outperforming what you
Mhm.
put out there, but or know that investors are used to startups maybe not quite achieving the hockey stick that they put in their pitch
Yeah. So
deck.
so
Right?
so one of my board members, this guy named Barry Cox, who passed away about 4 or 5 years ago. Barry once said a couple things. He said, first, welcome to the NFL. In other words, it's tough out there, when you're in the role that we're in as startup CEOs. The second thing, I remember him telling an investor this was, most startups don't meet their forecast, and you'll find we're no different. And, people laughed, and because it is true, most people don't. So if you sandbag, the reality is that's not going to help you, and that's not smart. And if you say the word conservative, that's a red flag for people, because people don't like hearing that.
Yeah.
And the reality is that investors are going to have multiple forecasts for your business. They're going to have a best case, a worst case, and a middle case. And understand that, because they're trying to model what's going to happen as best they can. So if you go in there with quote unquote conservative numbers, they're going to build off of those numbers and say, well, maybe this is the best case for your company. So you're better off doing what I call being realistically aggressive. Be on the high end, understanding you're going to get a haircut. Push as hard as you can to get there, because that's what we're in the game for, right? Is to push hard and to make things happen. And if you don't hit it, get out in front of the news. This is the other key, right? So if you miss your numbers, tell people and adjust your forecast as time goes on and get better and better at it. That's probably the smartest thing you can do.
Yeah, good. Okay, a couple other kind of open-ended questions. Top
Sure.
mistakes you're seeing CEOs make. You could take it broadly, but maybe with regards to fundraising, what are sort of the common patterns, repeating patterns you're seeing time and time again?
Oh,
How much time do we have, right?
yeah, exactly. So I was teaching a workshop this morning, and one of the people in the workshop, I really like him a lot, but he was making this mistake where he didn't want to hire. We were talking about key executive hires, and he wanted to wait on hiring the key executive because he didn't want to give away equity. And what we were talking through was, well, if you don't hire the key executive, it's not going to matter, because the investors are going to see risk, and your equity is going to be worthless because you're not going to be able to raise money for your company. And I think that's a common mistake, because people get so caught up in the numbers of what they own versus the reality that in all likelihood, it's going to be a binary result for you. Either you're going to make a lot of money, or you're going to make a salary for whatever time you're there, plus whatever return there is for the business. So don't get caught up on the small stuff. If you have to hire somebody and you have to give them a piece of the company, give them the piece of the company, because all it's going to do is enhance your piece of the company. That's a common mistake that I see CEOs make all the time, is that one. A second one might be, trying to game out what we think investors want rather than focusing on what we're doing. That's another classic mistake. Oh, this area is hot. This business is hot. So let's focus there. And I think that's just a massive mistake. I don't think that means you shouldn't understand what investors want, but don't twist yourself into being something that you're not, because that's not going to help you, at all. So there's just a lot of common sense things that people just make mistakes. Also understand that everything you do is going to bring up another question for investors. People think, oh, I'm being really smart by telling them, for example, I've spent all these years before starting, making things better for you and de-risking this. And what they don't understand is, okay, now that brings up a bunch of questions for me as an investor about, well, why did it take you so long? What's causing all these issues to happen? Whereas if you would have presented it more with a forward-thinking thought process, you would have been a lot better served. Those are just a few that popped to my mind. I'm sure if we keep going, I'll have a bunch more, but that's what pops into my head right now.
Yeah, sure. No, those are all good. Yeah, that's good. What about any common pitch mistakes? Do you sit in with your advisory clients very much on the pitches? I know you said earlier, don't bring too many people to the pitch meeting.
Yeah.
Yeah,
I think it's kind of it's a cardinal sin, I think, to bring an advisor to a pitch meeting. So no, I don't, but I will listen. I will coach. I will teach. So I think that one of the things that people struggle with is getting to the point quickly. I think that's a classic thing when I look at pitches, is that you have such a short time, to make an impression on people and to get through all the noise, that's out there. Because if you look at how many pitches investors are seeing, they're seeing a pitch a day at least. and you got to break through that noise. So you have two things you have to do really quickly. The first, and you have maybe 7 to 10 seconds to do this, is establish an emotional connection with your audience instantly. How do you do that? If for your audience, if anybody's interesting, go watch just about any Steve Jobs pitch at Macworld or whatever. Watch the Steve Jobs pitch for the iPhone. He does this thing right at the beginning, which I think is just really, really smart, where he just says, I've been working on, I've been waiting for this day for 2.5 years. And the minute he said that, even though, obviously everybody knew kind of what he was going to talk about, he had an audience connection instantly. You can do something similar just by saying, I am so excited to be here today. That's a nice generic one that you can use, but you have to do something to kind of build that emotional bridge between you and your audience, because investing is emotion first, logic second. And if people aren't emotionally invested in your story and you, it's very hard for them to want to invest. So that's the first thing you have to do. Then the second thing you have to do is, in that introduction period that you have, those first 2 slides, is explain directly, here's the pain problem that I'm solving, and here's how we solve it. And make it, you don't have to go into huge detail here. In fact, detail is your enemy. But we want to explain those 2 things to people. And if we can do that, we have gotten people excited about what we're doing, and now they're interested in hearing the rest of our story. That's our mission. And people, inevitably, every time I see somebody's pitch, they take too long, they meander, they don't get to the point, they don't build an emotional connection. And that's your mission, to get those 2 things done. And if you can do that, you're on your way, and people can get really excited. Another trick for your audience is tell the story of why you started this company. That works really well. And usually people have distinct reasons for why they're doing what they're doing and why they saw this problem. And that's a great segue into the rest of their story. So those things work really well.
Yeah, I love pitch decks that have start off with the personal story, and you can usually weave in the emotional piece to that pretty easily.
Yeah.
I think that's a real effective way. Okay, jumping around a little bit here, and I won't keep you too much longer, but what tips do you have for, well, let me back up a minute. What tips do you have for founders who are trying to get kind of heat and momentum on the deal, and kind of a corollary to that, how do you signal, if I'm talking to you as an investor, how do I best signal to you that other investors are interested without it making sound like, BS?
Okay. This is great, actually, because I think this is one of the big challenges. It's hard enough to get a term sheet right. So if you get a term sheet, congratulations, you're ahead of the game. But if you can get multiple investors competing, that's when you can get the best deal. So how do you do this? So let's say we're in this position where we've gone out to, let's say, 20 investors in a short period of time. I just worked with somebody who went out to, I think it was 46 people in about a month, which is really good. And he managed the sales process of raising money incredibly well. And what he did, which I've seen other people do, which I think is really clever, is out of that group, he had about 4 or 5 people who were really serious and were in his data room, doing all their stuff. He gave a deadline to everybody. He said, okay, we're sitting here August 31st. If you are interested, I've got other people that are interested. I'd like to see a term sheet from you by August 31st. I'm going to take offers until that point in time. And magically, what happened was he got 3 term sheets on August 30th and August 31st. And then he was able to negotiate the best deal he could, because now he had leverage on his side. So you could do this if you have multiple people that are excited. That's the way to signal. It's a fair thing to do. Investors will respect it. I'm working with somebody else who's doing the exact same thing right now that the other fellow did. It works quite well. But the downside is, if you don't have enough traction with investors, please don't do that, because all you're going to do is August 31st is going to come and go.
Yeah. And
you're going to be left holding the bag, and you're going to hurt your position. So you can only do this if you truly have traction, and you can kind of feel, and this is a lot of instinct and feel that you have to have about the deal. But if you have that and you feel pretty good that if a few of these people are really moving towards closing, then great. Then you can go ahead and do this. And it's a respectful way of doing it. And it puts everything on a clock, which is what you want to do.
That was going to be my sort of follow-up question is when do you introduce a deadline? Is it when you have, is there any kind of, I know it's instinct, but rule of thumb,
Yeah.
like I've got 6 investors in diligence or some rule of thumb, right? Because I think, I don't know, any thoughts on that? Like,
I think it's going to be probably before diligence in today's world. It seems like, and also I'm gonna also imagine by stage as well. But let's say we're early stage, we're Series A, let's say, raising our first venture round of funding, and we have a data room set up. We've already had our initial meeting or two with investors. People are interested. They're getting back to us. They're excited by what we're doing. Then I would say, okay, here's going to be the process, because you can kind of tell at that point because people are asking for information. We're opening up our data room. We're going to give you a month to get in there or whatever. And at the end of the month, we're going to expect an offer or not. And you can then monitor the progress, answer the questions. The other key to this process is you have to be on the ball too. So you have to have your data room really set up, because the mission here is to make it really easy for your investors. The easier you make it, the more likely it's going to be that a deal is going to get done. If you're causing problems, if you're not prepared, if you're making it difficult, then people are going to walk away because there's always another deal.
yeah.
So you want to make it really simple for people to do business with you, because the easier you make it, the more likely you're going to get a yes. And even if you get no's, better to hear the no's because you don't have to waste your time with them.
All right. A couple of last questions. What,
Sure.
and I know the answer can be many things, but what's sort of a rough outline of what should be in that data room before they say, we're going to open up our data room?
Okay. So, so let's walk through it. So all the financial information, every little bit of it you should have. So think about complete income statement, complete balance sheet, complete cash flow statement, all the stuff in detail, not just the high level thing that you might put in a pitch, but all of that detail. That should be in the data room. Competitive information on every single competitor. I saw one person do this. He had this baseball card format, which I thought was absolute genius. If you can imagine having these little baseball cards like things on each competitor with the key stats about each company. I thought that was really clever. That's a nice way to do things. You can do all sorts of things, but have all the competitive information, have all the detail on your market information. If there is technical diligence, you should have all the information on the technical diligence ready to go. Those would be the key areas that I would have.
Yeah, good. And full disclosure, we're going to actually build a data room into Founder Suite before too long, but what data rooms do you like? Do you have a recommendation of actual data room providers?
I don't know, Box, Dropbox, those guys seem to do pretty good. I think any of them are pretty good. I haven't seen anybody have problems.
Got it. Okay, great. Well, I won't keep you. Any last words of advice for founders out there raising capital, or, what do you find yourself, what advice for founders raising capital do you tend to give the most? So you probably find yourself giving some advice over and over again.
Yeah. Thank you. So I think the advice I would give people is don't be afraid to hear no. That's, I think, really important, because no's actually better than radio silence. And if you raise money, you're going to hear radio silence. It's just a classic thing that happens. Investors, for whatever their reasons are, many times will seem like they're excited and then magically they will go away. And it sucks. It's part of the deal. So I'd much rather hear no. Yes is your friend, no's your friend. Radio silence is not your friend. So you want to hear a definitive answer if you can, and be a polite pest. It's okay to follow up with people. It's okay after a few days if you haven't heard from them to be a polite pest. And this doesn't mean be a stalker. There's a difference between, being polite and being nice and following up after a few days and being a stalker. So after you follow up a couple times and you don't hear anything back, I think you're getting your answer and you move on, to the next investor.
How many times do you follow up before you move on? That's
probably about twice.
Twice. Okay.
I would follow up probably twice. And if I don't hear anything, because usually in my experience, if people are interested and excited about your deal, they move like crazy.
Yeah.
If a deal is kind of at a second level and it's not in the top level of deals that an investor is looking at, suddenly, instead of it being a day sequence, suddenly a day turns into 2 weeks or a month before they get back to you or before the next meeting's scheduled, and things move slower. I think it's a real good indication of what's going on. I'm sure there's somebody out there that had that happen, where it took a month and then another month and then finally they closed. Usually, in my experience, it's really quick. The challenge is that delta between starting raising money and finding the person that falls in love with your deal. And that's what you're looking for. You're looking for people to fall in love. So make it easy for them, build that emotional connection with people, get people excited by what you're doing. That's your mission when you're out there raising money.
Yeah, good. Very good. All right. Well, if people want to either get in touch or learn more, I know you have a blog, brettjfox.com. Anything else you want to kind of plug or what?
Yeah, sure. So you go to my blog. I also have a YouTube channel as well. And I'll have a free giveaway for everybody. If you need a free pitch deck template, I'll give you that. And you can just go to brettjfox.com/Founder Suite, and I'll have one there for you. And it's yours for free. And it has all the slides that you need, all sequenced out for you. It has a little note section at the bottom so that you can use that to help you develop your deck and understand what should be there, what shouldn't be in there. And hopefully that will get you on your way.
Excellent. Great. Well, I'm sure you'll get some people taking advantage of that, and lots of good stuff here. I always show people, that's how many notes I have. So that's always a good sign.
Cool. All right. Very good.
Excellent. Well, thank you so much.
It's my pleasure.
Content, and we'll talk to you later. Appreciate it.
All right. Sounds good. Thank you so much.
Over now.
Take care. Bye.